How to build financial freedom while working. 8 real-life strategies to build wealth. Introduction. Your salary is not a prison. Everyone says, you can't get rich on a salary. That's the biggest lie corporations want you to believe. They want you to think your paycheck is a cage, that financial freedom is only for entrepreneurs, investors, or people born into wealth. That if you're working a 9-to-5, you're destined to stay middle class forever. But here's the truth. That's exactly what keeps you poor. Not your salary, your belief about your salary. Let me be clear. Some of the wealthiest people in the world started with a salary. Warren Buffett worked as an investment salesman, earning a regular paycheck. Oprah was a news anchor. Jeff Bezos was a vice president at a hedge fund, earning a salary before starting Amazon. They didn't start rich. They started strategic. And here's what they understood that most people miss. A salary isn't a prison. It's a launchpad. Think about it. What does a salary give you? Predictable income, employer benefits, tax advantages, credit access, financial stability while you build wealth on the side. That's not a cage. That's a foundation. Most people see their salary as the ceiling, the limit, the final number that defines their financial potential. But wealthy people, they see it as the starting point, the seed capital, the fuel that powers their wealth-building machine. Let me show you the math. Let's say you earn $75,000 a year. Not rich, not poor, just average for a college-educated professional in most cities. If you save 20% of that salary, $15,000 per year, and invest it in a low-cost index fund earning an 8% annual average return, do you know what you have in 20 years? Over $700,000. In 30 years, nearly $1.7 million. Same salary, no promotions, no side hustles, no lottery tickets, just discipline, strategy, and compound interest. That's the power of treating your salary as a tool instead of a trap. But most people don't do this. Why? Because they spend their salary trying to look rich instead of using it to become rich. They buy the car to impress coworkers, the house to impress neighbors, the lifestyle to impress people who don't even care. And then they wonder why, after 10 years of working, they still have nothing saved. Here's the shift you need to make. Your salary is not your wealth. It's your wealth-building capital. Every dollar you earn is a soldier you can send to work for you. The question is, are you deploying them or wasting them?
In this audiobook, we're going to break down exactly how to turn your salary into financial freedom. You're going to learn 8 strategies that salaried workers use to build 7-figure net worths without quitting their jobs, without taking massive risks, and without waiting until they're 65. You'll learn how to automate your wealth so you never have to rely on willpower, how to maximize employer benefits most people ignore, worth $50,000 or more over your career, how to legally reduce your taxes by $10,000+ per year, how to optimize your budget so 30% of your income builds wealth while you still enjoy life, how to stack side income streams without burning out, how to strategically climb the career ladder and earn $1 million more over your lifetime, how to build a financial runway that gives you freedom and negotiating power, and finally, how to follow a 10-year plan to reach $1 million in net worth on a salary. This isn't theory. This is the playbook, the exact steps tens of thousands of salaried workers have used to go from paycheck to financially free. And here's the beautiful part. You don't have to quit your job. You don't have to start a business. You don't have to take the risks entrepreneurs take. You get to build wealth with the safety net of a steady paycheck, health insurance, and employer benefits. Entrepreneurs risk everything. You build wealth with training wheels. And you know what? That's smarter. So let's destroy the myth once and for all. Your salary is not a prison. It's not holding you back. Your lack of strategy is. This isn't about quitting your job. It's about making your job work for you. It's about turning your 9-to-5 into a wealth factory that runs whether you're awake or asleep. By the end of this audiobook, you'll never look at your paycheck the same way again. You'll see it for what it really is, the most powerful wealth-building tool you have. So take a deep breath, get ready, and let's turn your salary into financial freedom. Let's begin. Chapter 1. Automate your wealth, the set it and forget it system. Willpower fails. Automation wins every single time. Here's the problem with most financial advice. It assumes you're a robot, that you'll save money every month, that you'll resist temptation, that you'll make the right decision every single time you see your bank account.
But you're not a robot. You're human, and humans are terrible at consistent behavior. Studies show that over 90% of people who try to manually save and invest fail within the first year. Not because they don't want to succeed, but because willpower runs out. Life happens, expenses pop up, you see something you want, you forget, you procrastinate. You tell yourself, I'll do it next month, and next month never comes. But here's the secret wealthy people know. You don't need willpower if you have automation. Automation removes decisions, it removes temptation, it removes excuses. Your money moves from your paycheck to your wealth accounts before you even see it, before you can spend it, before you can talk yourself out of it. And once it's set up, you never think about it again. Your wealth builds in the background while you live your life. Let me show you exactly how to build a fully automated wealth system. I call it the automation pyramid. 4 layers, set them up once, and you're done. Layer 1, direct deposit split. The foundation of automation starts the moment your paycheck hits your account. Most people have one checking account. Their entire paycheck lands there. And from that one account, they try to pay bills, save, invest, and live. It's chaos. Everything mixed together, no clarity, no control. Here's what you do instead. Split your direct deposit into 3 accounts automatically. 70% to checking. This covers your living expenses, rent, food, transportation, fun, your day-to-day life. 10% to high-yield savings. This is your emergency fund and short-term savings. It grows at 4 to 5% interest while sitting there, ready when you need it. 20% to investments. This goes straight into your brokerage or retirement account. You never see it, it never tempts you, it just invests and grows. Most employers let you split direct deposit into multiple accounts. Log into your payroll system, add your savings and investment accounts, set the percentages. Done. Now every paycheck automatically distributes itself. You don't decide, you don't transfer, it just happens. Layer 2, bill automation. Next, automate every single recurring expense. Rent, utilities, internet, phone, subscriptions, insurance, everything that's the same amount every month or predictable. Set them all to autopay from your checking account. Why? Because when your bills are automated, you never miss a payment. No late fees, no damage to your credit score, and most importantly, no mental energy spent remembering due dates. Your checking account becomes a simple machine. Money comes in, bills go out. Whatever's left is yours to spend guilt-free because you've already handled your responsibilities. Use your bank's bill pay feature or set up autopay directly with each company. Takes 10 minutes per bill. Once it's done, you never touch it again.
Layer 3, investment automation. This is where wealth actually builds. Open a brokerage account with Vanguard, Fidelity, or Schwab. Pick a low-cost index fund. I recommend a total stock market index fund or an S&P 500 index fund. These funds track the entire market, cost almost nothing in fees, and historically return 8 to 10% per year. Then set up automatic investments. Every payday, or twice a month, or once a month, your brokerage account automatically pulls money from your checking and buys more shares of your index fund. Let's say you set it to invest $500 every month. That's $6,000 per year. Over 20 years at 8% average return, that's $295,000. Over 30 years, $745,000. You did nothing except set it up once. And here's the beauty. You also automate your 401k through your employer. Log into your benefits portal. Set your contribution to at least 10 to 15% of your salary. Choose a target date fund or an index fund. Enable auto increase. Most plans let you automatically increase your contribution 1% per year. Now you're investing pre-tax dollars, reducing your taxable income, and getting free money if your employer matches contributions. And it happens before you even see your paycheck. Layer 4. Rebalancing automation. The top layer is the most advanced, but it's simple to set up. As your investments grow, the balance between stocks, bonds, and other assets shifts. Rebalancing means adjusting back to your target allocation. Most people never do this. It requires effort, decisions, timing. But modern brokerage platforms offer automatic rebalancing. Once a quarter or once a year, the platform automatically sells overweight assets and buys underweight ones to keep your portfolio balanced. You set it once, it runs forever. Zero effort, maximum optimization. Now, let me show you what this looks like in real life.
Before automation. Meet Sarah. She earns $75,000 a year. She intends to save and invest, but every month, life happens. An unexpected expense, a night out with friends, a sale she can't resist. She saves inconsistently. Some months $200, some months $0. Over 15 years, she managed to save an average of $200 per month. Total saved, $36,000. With minimal growth, she has about $50,000. After automation. Now meet David. Same $75,000 salary, but David spent one afternoon setting up automation. His paycheck splits automatically, $500 to investments, $300 to savings, the rest to checking. His bills auto-pay. His 401k auto-deducts 10%. His brokerage auto-invests every payday. He never sees the money. He never makes a decision. Over 15 years, he invested $500 a month and saved $300 a month. Total invested $90,000. With 8% returns, his portfolio is worth $172,000. His savings, $67,000. Total, $239,000. David has $189,000 more than Sarah. Same salary, same time period. The only difference? One afternoon of setup. This is the power of automation. It removes you from the equation. You can't fail if there's no decision to make. Think about decision fatigue. Every day you make thousands of decisions. What to wear, what to eat, what to say in meetings. By the time you get home, you're exhausted. And that's when you're supposed to decide to save money, to resist buying something you want, to manually transfer money to investments. It's not going to happen. But when your wealth building is automated, it doesn't matter how tired you are. It doesn't matter if you had a bad day. It doesn't matter if you're tempted. The system runs without you. Out of sight, out of mind. No temptation, no guilt, just growth. Here's your challenge. This weekend, set up 3 automations. Automation 1. If your employer allows direct deposit splits, set it up. If not, set up an automatic transfer from checking to savings the day after payday. Automation 2. Set up auto investment. Whether it's increasing your 401k contribution or setting up auto invest in a brokerage account, do it. Automation 3. Automate one bill you're still paying manually. That's it. 3 actions, 2 hours max, and you never have to think about it again. Because here's the truth. Discipline is hard. Staying motivated is hard. Making the right choice every single day is hard. But automation is easy. So choose easy. Set it up once and get rich while you sleep.
Chapter 2. Maximize Employer Benefits. The hidden $50,000 plus. Your employer is giving you $50,000 plus in benefits. Most employees leave it on the table. Here's what most people think benefits are. Health insurance, maybe some paid time off, and that's it. They glance at the benefits packet once during orientation, pick a health plan, and never look at it again. But here's the reality. Your benefits package is a wealth-building ecosystem worth tens of thousands of dollars per year. And if you're not maximizing every single benefit, you're essentially giving your employer a discount on your labor. Let me show you the 7 most underused employer benefits and exactly how much money you're leaving behind. Benefit 1. 401k match. Free $3,000 to $10,000 per year. This is the closest thing to free money you'll ever get. Most employers match your 401k contributions. Typically, they match 50% to 100% of what you contribute, up to 3 to 6% of your salary. Here's an example. You earn $80,000 per year. Your employer offers a 100% match up to 6% of your salary. That means if you contribute 6%, which is $4,800, your employer adds another $4,800. That's $9,600 invested per year. Over 30 years at an 8% average return, that's over $1.1 million. Now here's the shocking part. Nearly 25% of employees don't contribute enough to get the full match. They're literally refusing free money. If your employer matches and you're not maxing it out, you're losing $5,000 to $10,000 per year. Over a 30-year career, that's $250,000 to $500,000 left on the table. Never, ever leave employer match money behind. Contribute at least enough to get the full match. If you can't afford more, that's fine, but get the match. It's a guaranteed 50 to 100% return on your money instantly. Benefit 2, HSA, Health Savings Account, the triple tax advantage. This is the most underrated account in personal finance, and most people either don't have one or don't use it correctly.
An HSA is available if you have a high-deductible health plan, and it comes with 3 massive tax advantages. First, you contribute pre-tax. If you're in the 24% tax bracket and contribute $4,000, you save $960 in taxes immediately. Second, the money grows tax-free. You can invest your HSA funds just like a 401k, stocks, bonds, index funds, and all the growth is tax-free. Third, you withdraw it tax-free for medical expenses. And after age 65, you can withdraw it for anything without penalty, just like a traditional IRA. The contribution limits are $4,150 for individuals and $8,300 for families in 2024. Here's the strategy most people miss. Max out your HSA every year. Invest 100% of it in a low-cost index fund, and pay for your medical expenses out of pocket from your regular income. Let your HSA grow untouched for 30 years. If you contribute $8,000 per year for 30 years and it grows at 8%, you'll have over $980,000. Tax-free. That's life-changing money hiding in a benefits account most people ignore. Benefit 3, ESPP, Employee Stock Purchase Plan. Instant 15% returns. If your company offers an ESPP, this is one of the easiest ways to generate instant risk-free returns. Here's how it works. You contribute a percentage of your paycheck, usually up to 15%, to buy company stock at a discount. Most plans offer a 10 to 15% discount off the market price. So if your company stock is trading at $100, you buy it at $85. You can often sell it immediately and pocket the $15 profit per share. That's an instant 15% return. Let's say you contribute $2,500 per quarter. At a 15% discount, you gain $440 per quarter. That's $1,760 per year, risk-free.
Over 30 years, that's $52,800 in pure profit. And if you invest those profits, the compound growth makes it even bigger. Most employees either don't enroll or don't maximize this benefit. Don't be one of them.
Benefit 4. Mega Backdoor Roth. $60,000 plus per year tax-free investing. This one is advanced and not available in every plan. But if your employer's 401k allows after-tax contributions and in-plan Roth conversions, you can contribute up to $69,000 per year, 2024 limits, into tax-free retirement accounts. This is a game changer for high earners who've maxed out their regular 401k and IRA contributions but want to save more. You make after-tax contributions to your 401k, then immediately convert them to a Roth account. Now that money grows tax-free forever. If you're in a high tax bracket and your plan allows this, it's worth tens of thousands in tax savings over your lifetime. Check with your HR department or benefits portal to see if this is available. Benefit 5. Tuition reimbursement. $5,000 to $10,000 per year free education. Most Fortune 500 companies and many mid-sized companies offer tuition reimbursement. They'll pay for you to go back to school, get certifications, learn new skills, up to $5,000 to $10,000 per year. And yet, fewer than 5% of eligible employees use it. Think about the ROI. Let's say your company reimburses $10,000 per year for 3 years while you get an MBA. That's $30,000 in free education. And an MBA typically boosts your earning potential by $20,000 to $50,000 per year. Over a 30-year career, that's $600,000 to $1.5 million in additional earnings, from a benefit most people ignore. Check your benefits portal, see what's covered, then use it. Benefit 6. Commuter benefits. Save $500 to $1,000 per year in taxes. If you commute to work using public transit or pay for parking, you can use pre-tax dollars to cover those costs. The IRS allows up to $315 per month, 2024, in pre-tax commuter benefits. If you're in the 24% tax bracket and you max this out, you save about $900 per year in taxes. It's not huge, but it's free money for something you're already paying for. Benefit 7. Dependent Care FSA. $5,000 per year tax-free child care. If you have kids in daycare, you can contribute up to $5,000 per year to a Dependent Care FSA. This money comes out pre-tax, reducing your taxable income. If you're in the 24% tax bracket, that $5,000 contribution saves you $1,200 in taxes every year. Over 10 years of childcare, that's $12,000 saved. Again, it's money you're spending anyway, but by running it through an FSA, you keep more of it.
Now let's contrast two employees. Employee A, the benefit ignorer, earns $80,000 per year, takes the salary, picks a health plan, ignores everything else. Real compensation value? $80,000. Employee B, the benefit maximizer, earns the same $80,000, but they max 401k match plus $4,800 employer contribution, max HSA plus $8,000 contributed saves $2,000 in taxes. Use ESPP plus $1,800 profit per year. Use tuition reimbursement plus $10,000 value. Use commuter benefits plus $900 tax savings. Use Dependent Care FSA plus $1,200 tax savings. Real compensation value? $108,700. Same salary, but employee B is earning $28,700 more in real value every year. Over a 30-year career, that's $861,000. And that's before accounting for investment growth on the 401k match, HSA, and ESPP profits. The difference between ignoring benefits and maximizing them is over $1.5 million in lifetime wealth. So here's your action plan. Step 1. Log into your company's HR portal or benefits system. Download the full benefits guide. Read every page. Step 2. Identify every benefit you're not currently using. Make a list. Step 3. Schedule time this week to enroll in at least one new benefit. If you need help understanding the details, email HR or schedule a meeting with a benefits advisor. Most companies offer free consultations. Step 4. During the next open enrollment period, max out every benefit that makes sense for your situation. Here's your challenge. This week, find one benefit you're not using. Enroll in it. Then calculate its lifetime value. Write that number down. Let it motivate you to never leave money on the table again. Because here's the truth. Your salary is the headline. It's what you negotiate. It's what you see on your offer letter. But your benefits? Those are the fortune hiding in the fine print. And the people who read the fine print end up $1 million richer.
Chapter 3. Tax Optimization. Keep $10K plus more per year. You're paying $10,000 plus in unnecessary taxes every year. Here's how to stop. Let me be clear about something. The tax code isn't designed to be fair. It's designed to incentivize certain behaviors. And one of those behaviors is saving and investing for your future. The government wants you to save for retirement. They want you to invest. They want you to start businesses. So they reward those actions with tax breaks. Massive ones. But here's the problem. Most people don't know these tax breaks exist. Or they know about them, but don't use them. And every year they hand over thousands of dollars in unnecessary taxes. Let me show you 6 legal strategies W-2 employees can use to keep more of their money. Strategy 1. Max pre-tax retirement accounts. This is the easiest and most powerful tax reduction strategy available to salaried workers. Every dollar you contribute to a traditional 401k or traditional IRA reduces your taxable income by $1. The limits for 2024 are $23,000 for a 401k and $7,000 for an IRA. Here's an example. You earn $100,000 per year. If you max out your 401k at $23,000, your taxable income drops to $77,000. If you're in the 24% tax bracket, that $23,000 contribution saves you $5,520 in taxes immediately. That's $5,520 you keep instead of giving to the IRS. Over 30 years, that's $165,600 in tax savings. And that's before we account for the $900,000 plus your investments will grow to at 8% average returns. This is the single biggest tax break available to most workers, and yet fewer than 15% of people max out their 401k. Don't be part of that 85%. Strategy 2. HSA, Triple Tax Advantage. We covered this in the last chapter, but it's worth repeating because the tax benefits are so powerful. Contributions to an HSA are pre-tax. Growth is tax-free. Withdrawals for medical expenses are tax-free. If you max out the family limit of $8,300 per year and you're in the 24% tax bracket, you save about $2,000 in taxes immediately, every single year. Over 30 years, that's $60,000 in tax savings. plus the $980,000 your HSA could grow to if you invest it properly.
Strategy 3. Tax loss harvesting. This one applies if you invest in a taxable brokerage account outside of retirement accounts. Here's how it works. If you have investments that have lost value, you can sell them at a loss to offset capital gains. The IRS lets you deduct up to $3,000 per year in losses against your ordinary income. Then you immediately buy a similar but not identical investment to avoid the wash sale rule. You stay invested, but you get a tax deduction. If you're in the 24% tax bracket and you harvest $3,000 in losses, you save $720 in taxes. Do this every year for 30 years, and that's $21,600 in tax savings. Strategy 4. Roth Conversion Ladder. This is an advanced strategy, but it can save you tens of thousands over your lifetime. If you have money in a traditional IRA or 401k and you experience a low-income year, maybe you're between jobs, took a sabbatical, or started a business that isn't profitable yet, you can convert some of that money to a Roth IRA. You'll pay taxes on the conversion at your current tax rate. But if you're in the 12% bracket instead of your usual 24% bracket, you just cut your tax bill in half. Over a lifetime, this strategy can save $50,000 to $200,000 for high earners who strategically convert during low-income windows. Strategy 5. Dependent tax credits. If you have kids, you're eligible for significant tax credits. The child tax credit is $2,000 per child under 17. The child care credit can be worth $3,000 to $6,000 depending on your expenses and income. For a family with 2 kids in daycare, that's potentially $10,000 plus in tax reductions every year. Over 10 years of raising kids, that's $100,000 saved. Make sure you're claiming every credit you're entitled to.
Strategy 6. Side business deductions. Even if you only freelance or consult for $5,000 per year, having a side business opens up a world of tax deductions. You can deduct a portion of your home office, your internet, your phone, your car expenses, your computer, your software subscriptions, basically anything you use for your business. Let's say you freelance for $5,000 per year, and you have $2,000 in legitimate business expenses. You can deduct those expenses, reducing your taxable income. If you're in the 24% tax bracket, that $2,000 deduction saves you $480 in taxes. Add in other deductions, and you could easily save $1,500 to $3,000 per year. Over 30 years, that's $45,000 to $90,000 in tax savings. Now let me show you what this looks like in practice. Before tax optimization, you earn $100,000 per year, you take the standard deduction, you pay about $18,000 in federal taxes. After tax optimization, you max your 401k, $23,000 deduction, you max your HSA, $8,000 deduction. You harvest tax losses, $3,000 deduction. You have a small side business with $5,000 in deductions. Your taxable income is $100,000 minus $23,000 minus $8,000 minus $3,000 minus $5,000 equals $61,000. Your taxes about $9,000. You just saved $9,000 in taxes in 1 year. Invest that $9,000 every year for 30 years at 8% returns, and it grows to $1 million. That's the difference between being tax ignorant and being tax optimized. So how do you actually implement this? Use tax software like TurboTax Premium or H&R Block. They'll walk you through deductions and credits. Or hire a CPA. It costs $300 to $500 per year, but a good one will save you $3,000 to $10,000 annually.
That's a 6 to 20x return on investment. If your income is under $79,000, you can use IRS Free File for completely free tax prep. Here's your challenge. Calculate your current effective tax rate. It's simple. Total taxes paid divided by total income. Then research one deduction or credit you're not currently using. Just one. Implement it this year. Because here's the truth. The tax code is 7,000 pages long. Most of it is legal ways to pay less in taxes. The wealthy use every single one. You should too. Stop overpaying. Start optimizing. Keep your money. Chapter 4. The 50-30-20 Rule, optimized for salaried workers. The 50-30-20 budget rule works, but for W-2 employees, there's a better version. You've probably heard of the 50-30-20 rule. It's simple. Spend 50% of your income on needs, 30% on wants, and save 20%. It's a good starting point, but it has a fatal flaw for salaried workers. It doesn't account for employer benefits, pre-tax deductions, and tax optimization strategies that fundamentally change how your money works. So here's the optimized version for people with W-2 income. 50, 20, 30. Same numbers, different order, and that reordering makes all the difference.
50% needs, but optimized. Needs are non-negotiables. Housing, food, transportation, utilities, insurance. The things you must pay to survive and function. But here's the key. Most people overspend on needs because they confuse needs with normal. You don't need a $2,000 apartment if a $1,500 one works. You don't need to spend $600 on groceries if meal prepping cuts it to $400. You don't need a car payment if public transit or a paid-off used car gets you to work. Here's how to optimize each category. Housing. Max 30% of your take-home pay, not gross. If you're earning $5,000 per month take-home, that's $1,500 max for rent or mortgage, not $2,000, not $2,500. Living below your means here unlocks hundreds of extra dollars for wealth building. Food. Meal prep and cook at home. Target 8 to 10% of income. For $5,000 per month, that's $400 to $500. Eating out regularly pushes this to 15% plus. The difference? $250 to $500 per month you can invest instead. Transportation. Use public transit if available, or drive a paid-off reliable car. Keep this under 10% of income. That's $500 per month max. No $400 car payments, no $200 insurance on a new car, no $150 in gas for a gas guzzler. Utilities and insurance, 5 to 7% of income. Bundle services, shop around for insurance annually, negotiate bills. The goal? Keep total needs at 50%, but if you can trim it to 45% or 40%, redirect every saved dollar to wealth building. 20% wants, not 30%, this is the cut. This is where most budget advice fails. It tells you to spend 30% on wants, on fun, on lifestyle. But if you want to build serious wealth on a salary, you need to flip that script. Wants are important. Entertainment, dining out, hobbies, travel. These things make life worth living, but they don't need 30% of your income. 20% is enough if you're intentional. Here's the strategy. Value-based spending. Spend freely on what you truly love, cut ruthlessly on everything else. Love travel? Spend on that, but cut the $200 per month in subscriptions you barely use. Love nice dinners? Great, but skip the $15 lunches out 5 days a week. Love your hobbies? From them, but cancel the gym membership you haven't used in 6 months. Intentional spending lets you live well on 20%, and the 10% you cut, that's $500 per month on a $5,000 income. Invested over 25 years at 8%, that's $240,000. You didn't deprive yourself, you just got intentional.
30% wealth building, not 20%. This is the boost. This is where the magic happens. Instead of saving 20%, you're saving 30%. Here's how to break it down. 15% to retirement. Max your 401k contributions. Get the full employer match. If you can, contribute to a Roth IRA as well. This 15% includes your contributions plus your employer match. 10% to taxable investments. Open a brokerage account. Invest in low-cost index funds. This money grows tax efficiently and is accessible before retirement if you need it. 5% to emergency fund or debt payoff. Build your emergency fund to 6 to 12 months of expenses. Once that's done, use this 5% to aggressively pay off high-interest debt. Once debt-free, redirect it back to investments. Let's see what this looks like with a $75,000 salary, which is about $5,000 a month take-home after taxes. Needs, $2,500, 50%. Wants, $1,000, 20%. Wealth building, $1,500, 30%. That's $1,500 per month invested, $18,000 per year. Over 25 years at 8% average returns, that's $1.4 million. Compare that to the standard 50-30-20 rule, where you'd save $1,000 a month. Over 25 years, that's $950,000. The difference, $450,000 from a simple reallocation. Now let me show you a real budget transformation. Before optimization, income is $5,000 a month take-home, following standard 50-30-20. Needs, $2,500. Wants, $1,500. Savings, $1,000 a month. Over 25 years, $480,000 saved and invested. After optimization, same $5,000 a month income, following optimized 50-20-30. Needs, $2,500, trimmed subscriptions, meal prepped, negotiated bills. Wants, $1,000, intentional spending, cut waste. Wealth building, $1,500 a month. Over 25 years, $720,000 saved and invested. The difference? $240,000 from one budget reallocation. Same income, same quality of life, just smarter allocation. So how do you actually implement this? First, track your expenses. Use Mint if you want free and automatic. Use UNAB, You Need a Budget, if you want the best budgeting tool available. It's $99 a year and worth every penny. Use Personal Capital if you want investment tracking built in, or just use a simple Google Sheets template. Track for 30 days, every dollar. Categorize everything into needs, wants, or wealth building. Then analyze. Where are you overspending? Where can you cut $200, $500? Redirect those cuts to your wealth building category. Automate the transfers and never look back. Here's your challenge. Track every single expense for the next 30 days. Categorize it into 50, 20, 30. Find at least $200 per month to redirect from wants or needs into investing.
That $200 a month invested over 25 years at 8% is $192,000. Find it, redirect it, build wealth. Because here's the truth. Budgets aren't restrictions. They're not about depriving yourself. Budgets are wealth blueprints. And if you follow the right blueprint, it leads to millions. Chapter 5. Side income stacking without quitting your job. Your 9-to-5 salary is your foundation. Side income is your accelerator. Here's the reality. Your salary gives you stability, predictable income, benefits, security. That's powerful. But it's also capped. You can only work so many hours. You can only get so many raises. There's a ceiling. Side income, no ceiling. It's pure upside. And the best part? You don't have to quit your job to build it. Let me show you the three-tiered side income stack designed specifically for full-time employees. Tier 1. Skill monetization. $500 to $2,000 per month. Your job is teaching you valuable skills right now, skills other people will pay for. If you're an accountant, you can freelance bookkeeping at $50 to $100 per hour. 10 hours a month is $500 to $1,000 extra. If you're in marketing, you can manage social media for small businesses. One client at $500 to $2,000 per month. 2 clients, that's $4,000 extra monthly. If you're an engineer, offer weekend consulting at $100 to $200 per hour. 5 hours a month is $500 to $1,000. If you're a teacher, tutor online through Wisant or tutor.com. $30 to $60 per hour. 10 hours a week is $1,200 to $2,400 per month. The platforms make this easy. Upwork, Fiverr, TopTal, LinkedIn. Create a profile, list your skills, apply to projects, start earning within weeks. Tier 2. Passive income streams. Earn while you sleep. Tier 2 is about setting up income that doesn't require your active time. Dividend stocks. Invest $50,000 in dividend-paying stocks yielding 4 to 6%. That's $2,000 to $3,000 per year in passive income. REITs, real estate investment trusts. Invest $10,000, earn $400 to $800 per year in dividends. High-yield savings. Park your $30,000 emergency fund in a high-yield account at 5%. That's $1,500 per year in interest. Passive. Rental property. If you have capital, buy a rental. $100,000 down payment. Collect $2,500 in rent per month. Profit $500 to $800 after mortgage and expenses. Digital products. Create an online course, an ebook, or templates once. Sell them forever. Potential? $200 to $2,000 per month with zero ongoing work. Passive income takes time to set up, but once it's running, it pays you whether you're working, sleeping, or on vacation.
Tier 3. Equity and ownership. Long-term wealth. This tier is about building ownership that can explode in value. Join an early-stage startup as employee number 10 to 50. Negotiate 0.1% to 1% equity. If the company exits, that equity could be worth $50,000 to $500,000 or more. Angel invest in startups. Invest $5,000 to $25,000 per year. High risk, but if 1 in 10 succeeds, it can 10x or 100x your money. Build your own product or SaaS on nights and weekends. In year 2 or 3, it could generate $1,000 to $10,000 per month, or you could sell it for a lump sum. This tier isn't fast, but it's how you build serious wealth. Now let's talk time management. You work full-time. How do you add side income without burning out? Phase 1, months 1 to 3. Spend 5 hours per week learning and setting up. Create profiles, build a portfolio, apply to gigs. Phase 2, months 4 to 9. Work 10 hours per week. Earn $500 to $1,000 a month. Refine your process. Phase 3, months 10 to 18. Scale to 10 to 15 hours per week. Earn $1,500 to $3,000 a month. Phase 4, year 2 plus, automate or outsource. Work 5 hours per week, maintaining $2,000 to $5,000 a month. Here's a real example. A salaried worker earning $85,000 per year starts freelance consulting 10 hours per week. Year 1 earns an extra $12,000, $1,000 a month average. Year 2 earns $24,000, $2,000 a month consistent. Year 3 earns $36,000 plus, $3,000 a month plus adds passive streams. Total 3-year side earnings, $72,000. Invested at 8% returns, that's over $90,000. And here's the bonus. The skills from side work make them more valuable at their day job. They get promoted. Salary jumps to $100,000. One income stream is fragile. Multiple income streams are unstoppable. Stack them. Before you start, check your employment contract for non-compete clauses. Don't use company time or resources for your side work. And if you're earning over $10,000 per year from side income, consider forming an LLC to separate your finances and protect yourself legally. Here's your challenge. Identify one skill from your current job. Create an Upwork or LinkedIn profile. Apply to 5 gigs this week. Just start. Because one income stream equals fragile. Multiple streams equal unstoppable. Stack them.
Chapter 6. The Career Ladder Strategy. Maximize your primary income. Most people stay at the same company 5+ years and wonder why their salary barely moves. Here's the game. The truth is simple. Loyalty does not equal raises. Strategy equals wealth. Here's the data. If you stay at the same company for 10 years, you'll average about 3% annual raises. That's a 34% total increase over a decade. But if you strategically job hop every 2 years, you'll average 15 to 20% raises per move. Over 10 years, that's a 100 to 150% increase. Example, start at $60,000. Stay 10 years with 3% annual raises, you're at $80,000. Job hop 5 times with 15% raises each, you're at $120,000. That's a $40,000 per year difference. Over a 30-year career, that's $1.2 million in extra earnings from strategic moves alone. Companies don't reward loyalty with wealth. Markets do. Play the game. Chapter 7. Build a 6 to 12-month runway. Financial security buffer. Salaried workers have one advantage entrepreneurs don't: predictable income. Use it to build unshakable security. The runway rule is simple. 6 months of expenses minimum, 12 months ideal. Why do salaried workers need this? Job loss, layoffs, company bankruptcy, health crises, career pivots, and most importantly, negotiating power. When you have 12 months of expenses saved, you don't need your job, you choose it. That shift changes everything. Here's how to calculate your runway. Add up essential monthly expenses: rent, food, insurance, utilities, minimum debt payments. Let's say that's $3,500 per month. 6-month runway, $21,000. 12-month runway, $42,000. Now, how do you build it? Phase 1. Save your first $1,000 in 4 weeks. Cut expenses 20%. Sell unused items. Save $250 per week. This covers small emergencies like car repairs. Phase 2. Build to 6 months over the next 6 to 12 months. Save $500 to $1,000 per month aggressively. Automate the transfer every payday. Treat it like a non-negotiable bill. Phase 3. Expand to 12 months over the following year. Save $500 per month until you hit $42,000. Now you have true financial security.
Keep this money in a high-yield savings account earning 4 to 5% APY, not invested. You need it accessible with no volatility. A $42,000 runway at 5% earns $2,100 per year in interest while it sits there protecting you. Here's the contrast. Worker with no runway gets laid off. Panic. Takes any job out of desperation, often lower pay, spirals. Worker with 12-month runway gets laid off, stays calm, negotiates severance, takes time finding a better job, often lands a higher salary. The runway pays for itself 10 times over. Real story. A worker earning $95,000 built a $50,000 runway. When layoffs came, they negotiated 6-month severance, used the time to interview at 15 companies without desperation, landed a $125,000 job. That's a $30,000 annual raise enabled by the runway. Over a career, that's $1.2 million. The psychological shift is everything. Without a runway, you think, I need this job. You're desperate, exploited, underpaid. With the runway, you think, I choose this job. You're empowered, respected, properly compensated. Your runway also unlocks opportunities. Start a business, go back to school, relocate, negotiate fearlessly. You can take risks because you have a safety net. Here's your challenge. Calculate your essential monthly expenses. Multiply by 12. That's your target. Open a separate high-yield savings account this week. Deposit $500. Start building. Because salary is your income, runway is your freedom. Build both. Chapter 8. The 10-Year Salaried Millionaire Plan. $1 million in net worth in 10 years on a salary. Not a dream, a math problem you're about to solve. Is it possible? Yes. Is it easy? No. Is it worth it? Absolutely. Here's the formula. Start with a $75,000 to $100,000 salary, achievable through strategic career moves. Save 30 to 40% of your income. Invest it in index funds averaging 8% returns. Do this for 10 years. Result? Over $1 million in net worth. Let me show you the exact roadmap year by year. Year 1, foundation. Net worth is $15,000. Salary is $75,000. You save and invest $22,000, which is 30%. You build a $10,000 emergency fund. You automate everything. You max your 401k match. By the end of year 1, your net worth is $15,000.
Year 3. Optimization. Net worth $75,000. Another move or promotion. Salary $90,000. You save $32,000. Side income grows to $12,000. You optimize taxes and save an extra $5,000, which you invest. Net worth $75,000. Year 4. Compounding kicks in. Net worth $120,000. Salary $95,000. Save $35,000. Side income $18,000. Your portfolio is now large enough that investment gains start to accelerate. Net worth $120,000. Year 5. Halfway point. Net worth $180,000. Another strategic job hop. Salary $105,000. Save $40,000. Side income $24,000. You're halfway to $1 million. Net worth $180,000. Year 6. Momentum. Net worth $260,000. Salary $115,000. Save $42,000. Side income $30,000. Compounding is accelerating. Your portfolio grows faster than you can contribute. Net worth $260,000. Year 7. Major growth. Net worth $360,000. You've reached director level or senior individual contributor. Salary $125,000. Save $45,000. Side income $35,000. Net worth $360,000. Year 8. Exponential. Net worth $480,000. Salary $135,000. Save $48,000. Side income $40,000. Here's where it gets interesting. Your $360,000 portfolio grows 8% this year. That's $28,800 in gains alone. You're earning almost $30,000 per year just from your investments working for you. Net worth $480,000. Year 9, accelerating. Net worth, $630,000. Salary, $145,000. Save, $50,000. Side income, $45,000. Portfolio gains, $38,000. The snowball is massive now. Net worth, $630,000. Year 10, millionaire. Net worth, $1,050,000. Salary, $155,000. Save, $52,000. Side income, $50,000. Portfolio gains this year alone, $50,000. Your investments are now earning as much as your side income. Net worth, $1,050,000. Here's the breakdown. Over 10 years, you contributed $400,000 from salary savings, another $200,000 from side income, and your investments generated $450,000 in compound growth. Total, $1,050,000. Now, compare this to the average salaried worker. Same $75,000 starting salary, but they save only 10%, have no side income, and never optimize. After 10 years, they have $120,000 in net worth. You have $1,050,000. The difference? $930,000. Here's what makes this work. 6 critical success factors.
1. Don't inflate your lifestyle. When you're earning $150,000, keep living like you earn $50,000. Bank the difference. 2. Automate everything. No willpower needed. Money moves before you see it. 3. Job hop strategically, every 2 years if it makes sense. Chase market rate, not loyalty bonuses. 4. Side income gets reinvested, not spent. Every dollar from side work goes straight to wealth building. 5. Stay invested through crashes. Don't panic sell. Market downturns are buying opportunities. 6. Start now. Compound interest needs time. The difference between starting today and starting in 5 years is $300,000. So what does $1 million in net worth enable? You can retire in your 40s or 50s. You achieve financial independence. Work becomes optional. You can start your dream business with a safety net. You can move anywhere in the world and live off 4% withdrawal rates, which is $40,000 per year. You can fund your kids' education. You can build generational wealth. $1 million isn't the end. It's the beginning of true freedom. Here's your challenge. Write your 10-year plan today, year by year. Income targets, savings goals, net worth milestones. Print it. Put it somewhere you'll see it. Review it every quarter. Track your progress. Adjust when needed, but stay the course. Because here's the truth. People say salary workers can't get rich. You just proved them wrong, on paper. Now go do it in real life. Conclusion. Salary is your superpower. You've just learned 8 strategies that turn a salary into financial freedom. Let's recap fast. Strategy 1. Automate your wealth. Set it once, forget it forever, and get rich while you sleep. No willpower needed, just systems. Strategy 2. Maximize employer benefits. Most employees ignore $50,000 plus in hidden wealth. You won't. 401k matches, HSAs, ESPPs, tuition reimbursement, use them all. Strategy 3. Tax optimization. Keep $10,000 plus per year legally. Max pre-tax accounts, harvest losses, claim credits, and deduct strategically. The tax code rewards savers. Be one. Strategy 4. The 50-20-30 budget. Optimized for salaried workers. 30% to wealth building, not 20%. That 10% difference is $240,000 over 25 years. Strategy 5. Side income stacking. Your salary is stability.
Side income is acceleration. Stack freelancing, passive income, and equity. Build multiple streams without quitting your job. Strategy 6, the career ladder strategy. Job hop every 2 years. Negotiate aggressively. Chase market rate, not loyalty. Over 10 years, strategic movers earn $1 million more than stayers. Strategy 7, build a 12-month runway. 6 months minimum, 12 months ideal. This isn't just emergency money, it's freedom, negotiating power, the ability to walk away, the confidence to take risks. Strategy 8, the 10-year millionaire plan. $1 million net worth on a salary, not a dream, a roadmap. You saw the math. Year by year, it works.
Now, let me be honest with you. This requires discipline. It requires patience. It requires strategy. It's not a get-rich-quick scheme. It's a get-rich-for-sure plan. But it works. Entrepreneurs gamble. They risk everything. Their savings, their time, their mental health, and most of them fail. You build wealth with a guaranteed paycheck, with employer benefits, with tax advantages, with predictable income. That's not weakness. That's power. Your salary isn't a ceiling. It's a foundation. And what you build on that foundation is entirely up to you. Most people see their paycheck and think this is all I'll ever have. You see it as seed capital, fuel, the starting point for a wealth-building machine. Here's your final challenge. Pick one strategy from this audiobook, just one. Implement it this week. Automate one transfer, enroll in one benefit, optimize one tax deduction, cut one expense and redirect it to investing. Apply to one freelance gig. Update your resume and research one company. Open a high-yield savings account. Write your 10-year plan. Just one action, this week. Because here's what happens next. That one action leads to another. 1 week becomes 1 month. 1 month becomes 1 year. 1 year becomes a decade. And in 10 years, you're unrecognizable. Let me paint 2 pictures for you. Picture 1, the average salaried worker 10 years from now. Same company, same position, maybe a few 3% raises. Total salary, $85,000. Net worth, $50,000. Stressed about money, no options, stuck, wishing they'd started sooner. Picture 2, the strategic salaried worker 10 years from now. 4 companies, strategic moves, director-level position. Total comp, $155,000. Side income, $50,000 per year. Net worth, $1,050,000. Options everywhere. Freedom. Proof that it works. Which picture do you want to be?
Here's what you need to remember. Predictability is power. Your paycheck arrives every 2 weeks. That's stability most people dream of. Use it. Benefits are wealth multipliers. $50,000 plus in value hiding in your benefits package. Unlock it. Automation is discipline-free riches. Set it up once, never think about it again, get rich anyway. Patience equals millionaire status. Compound interest needs time. Give it 10 years, become a millionaire. Your 9 to 5 isn't your prison, it's your wealth factory. And now you know how to run it like one. You don't need to quit your job to get rich. You don't need to take massive risks. You don't need to start a business or win the lottery. You just need to optimize the income you already have. And you just learned exactly how to do it. So stop believing the lie that salary workers can't build wealth. You can. You will. You just proved it's possible. Now go prove it's real. Take one action this week. Start building. And 10 years from now, look back at this moment as the day everything changed. Your salary is your superpower. Now use it.